All right. It is Friday. And as you know, on Friday, we do the Friday financial news with Mr. Michael Zuber. How are you, Michael?
Doing good, man. Thanks for doing this. I know you're on the road going to see the one and only Pace Morby and Ryan Pineda. So thanks for making time for this. This is pretty awesome.
I love it. I love it. I love the consistency in doing this every week. You know, it keeps my mind sharp on what's going on. And so let's just get right into it. Jobs report. What happened with the job numbers this week?
Wow, the jobs number came out. It's really an interesting report because we were set up by the White House to think this might be a bad number. Like, hey, be careful. This new variant right during the sampling season, it could actually be negative, which would have been a big shock. It turns out it was not only positive, but it was way positive, right? I think the highest expectation I saw was 150,000, came in at 467,000. So a huge beat. On top of that, Ty, we had a January rise and then a November rise. Basically, we added 1 million jobs over expectations for the last 3 months. So the economy on the jobs front is humming. It is moving along. So that's good news. Participation rate. We are starting to see people come back, right? Participation rate in the jobs market's been down about 1.92%. That ticked back up. It's interesting. People will be going, how'd this happen? It's because of the participation rate. Unemployment, U3 went up, right? U3 went up from 3.9 to 4%. This is what I told you was going to be happening. I told you that unemployment would be higher at the end of December than it is today because the participation rate will come back, and that is already happening. So again, unemployment rate up. And then the nail in the coffin that I believe is the final thing that will mandate the Fed to raise rates 0.5% was wages. Wages were up 5.7%. It is still going up. It hasn't rolled over. It hasn't peaked. It hasn't flattened. It was still higher in January than December than November. Wages are going up, and that means inflation is getting stickier, in my opinion. So I think Jerome Powell, this report's like, well, there we go. We got to raise by 0.5 point coming out of the gate. Why is that important? Because we brought it to you months ago, and it feels good to be right, frankly. I won't lie.
I love it. Well, you know, you've been calling it all. I mean, I feel like for the last 6-9 months, we've been talking about the same things, and you've been calling it literally month by month. So very spot on.
Cool. Yeah, no, feels good. I mean, I talked about it in the summer that March to June, they were going to raise. They had to come out by 0.5 to get their reputation back. And now we're here, and we'll know soon, but it certainly feels like we're going to be right.
It's interesting too that intuitively, I've just noticed this last week and a half. I just noticed I'm out and about and a lot more cars on the road, a lot of traffic, a lot more. It definitely felt like it, but for you to give that confirmation about jobs, it definitely feels like people are going back to work. So very interesting time. So let's talk about interest rates. How do you see this affecting interest rates specifically for investors, for the homeowner, 30-year mortgages, fixed rate product? What do you see there?
Mortgage rates are going up is a very simple answer, right? There was some pause this week.
I hope my internet did not glitch.
Nope, you're good. I can still hear you. You okay, Ty?
Nope,
you're still there.
Okay, I don't know how the recording will look. So how do you see this affecting interest rates?
That's okay. We were still recording. It's fun. What I would tell you is rates are going up. They already have. Rates are going up today. The 10-year is at 1.9. We are just on the uptrend. And I think what normally happens when rates rise is people run off the sideline. They refi, they buy because they've been waiting. They missed the bottom. Now they're going to rush. So Q1 is going to be a very messy number in the real estate market because transactions will be up, inventory is low. It's probably the worst time to be a first-time home buyer right now than in my entire 20 years. Because we have no inventory. Now you have this artificial prod to get started because you don't want to miss out on rates. It's a bad time to be a first-time home buyer.
Yeah. It's interesting. I love, though, what you talk about time in the market versus trying to time the market. If somebody's going to stay in their home for the next 5, 7, 10 years, getting that low rate definitely makes a difference. Would you agree?
Oh yeah, I mean, people may not want to hear this, but if you get a rate as an owner occupant with a 3 on it or an investor with a 4 on it, that is still unnaturally low. I believe natural interest rates for owners will be in the 4s and investors in the 5s. We just had a 2-year period where we were in a health crisis and the government was flooding the market and buying $100 billion in bonds. And now they're not. And oh, by the way, not only they're not buying, they're going to be selling, which is going to goose rates higher also. So, yeah, it doesn't feel good to get a mortgage at 3.5 when you could have had it at 2 3/4, but 3.5 is still, an amazing rate.
Absolutely. Absolutely. I think we'll look back on this time, 10, 15, 20 years from now and say, hey, remember when interest rates were in the threes? Is that something that you kind of forecast?
Yeah, I think naturally speaking, rates are 4.5 to 5.5 because the Federal Reserve needs to have ammunition. I interviewed Jason Hartman earlier in the week, and he talked about, loading the gun. Right now, the Fed has done things so unnatural that they've emptied the gun, meaning they have no bullets left. Yep. They need to reload it. And reloading it means stop buying bonds, which they're doing ending in March, and raising rates, which again, I think will be a half. So again, the business cycle is real. We will have other events happen. And they need to be able to lower rates. They can't go below where they are now unless they're going to go negative, which I don't think they do. But and oh, by the way, I think we have negative rates right now, right? Borrow at 4 and inflation is 7. That's a -3 in my book. So I would tell you negative rates are already here.
Yep, absolutely, 100%. So let's transition. Let's talk about inventory. What are you seeing with inventory right now?
Man, inventory is at a we ended December at a record low. January is lower, and I'm going to tell you February will be lower. We have a lot of people coming off the sidelines. I'm seeing stupid behavior again from owners who are overpaying, waiving conditions because of interest rates. Interest rates have been the thing to get them off the fence. Unfortunately, they're getting off the fence into no inventory environment. And anytime you act without reason, you make bad financial decisions. And I think there's some bad financial decisions being done today because you can't buy what's not there and there's no inventory.
Absolutely. And let's talk about owner occupant demand. I mean, it just seems as though, again, because of the rates starting to move, because of low inventory, talk about owner occupant demand.
Yeah, what I would tell people in Q1, and I've been very clear in my course and my YouTube channel, that I think Q1 of 2022 is the time to be careful, because I think you're going to have all these owners coming off in writing offers 10, 15, 20, 25, 50 over, waiving conditions. And as an investor who wants a deal, who's hungry for a deal, it's hard to keep getting outbid. What I would tell you, let the owners have buyer's remorse. Let them do what they're going to do. Wait until the summertime, because inventory has to build and it has to slow down. And yes, you may have a higher rate, but if you can work out a deal where maybe you're paying less because the owner's got to move for whatever reason, then it's all about the yield. And you can get a great deal at a higher interest rate. You just got to, pay a little less.
Absolutely. Absolutely. Well, very interesting times, Michael. I got to say that you have been so on it, and I feel privileged to do this with you on Fridays, doing a summary of Friday financial wrap up with you. If you don't know, for viewers, if you, for some reason, I'm guessing a lot of you already subscribe to this man's YouTube channel. Absolutely amazing. He puts out the best financial news. You did something with the studio. I want to say you have is that a backdrop or is that a different place in that?
So I've actually rented an office space down the road, and actually I'm going to turn my web camera around and show you. I have here, there's my little daily financial news. Yeah. So I do that. I do that in the morning, right from that corner. I ordered a stool so I can sit down and whatnot. So the studio's coming together. It's finally been painted. So yeah, it's, more to come. I'm spending some big money here to make it nice and welcoming. And one day when you're in the Bay Area, you're going to come into my office next door and we'll do the interview live.
Yes, I absolutely love that. Michael, thank you for all that you do. Again, if you've already read the book, One Rental at a Time, you can find it on Amazon. He also has Conversations with Real Estate Millionaires, the second book. Absolutely phenomenal. You can subscribe YouTube at One Rental at a Time. He's on social, all Facebook, Instagram. Thank you, Michael, for all that you share and do, brother. Appreciate you. Have a great weekend.
You got it. Enjoy your day.
Thank you.